Is it really possible to qualify for an investment property loan without using your personal income?
Yes, and it's one of the most powerful tools in real estate investing that most people have never heard of. It's called the DSCR loan, which stands for Debt Service Coverage Ratio, and it changes everything for investors who've been told no by traditional lenders.
Before we get into the details, why is investor financing such a hot topic right now in this specific market?
Well, a few reasons. First, spring is when investors move. Tax season just wrapped up, and people have clarity on their financials. And the smart investors I work with use April and May to position for the summer and fall. Second, there's a segment of buyers who've been sitting on the sidelines because traditional mortgage approvals doesn't work for them. Business owners, self-employed professionals, people with complex income. And DSCR financing opens the door for exactly these buyers. Third, rental income as a wealth-building tool is getting a lot more attention. And there's a real gap between what people think is possible and what actually is. So this is the right conversation to be having right now.
Let's start with the biggest misconception. What do most people get wrong about qualifying for investment property loans?
They think it works exactly like qualifying for a primary home, that the lender looks at their salary, their W-2, their tax returns, and makes a decision based on personal income. That's one way to do it, but it's not the only way, and for a lot of investors, it's not the best way. A DSCR loan, which stands for Debt Service Coverage Ratio, qualifies you based on the rental income the property generates, not your personal income. So not your W-2s, and as a result, the lender looks at one question: does the rental income for this property cover the mortgage payment? If the answer is yes, you can often qualify. Even if you're self-employed, even if your tax return doesn't show a lot of income, even if you already own multiple properties.
How does the DSCR calculation actually work? What does the lender look at?
It's actually a straightforward ratio. DSCR equals monthly rental income divided by monthly debt obligation, meaning the mortgage payment, taxes, insurance, and an HOA. Most lenders want a DSCR of 1.0 or above. That means the rental income covers the cost of ownership. Some lenders will go below 1.0 with a higher down payment. And a DSCR of 1.25 or above is considered strong. It means the property generates 25% more income than the cost to own it. The market rent for the property is typically verified by an appraiser. They will pull comparable rentals in the area to establish what it should rent for. Down payment is typically 20 to 25% minimum, and the credit score requirements are usually 660 or above, sometimes 680 for the best terms.
Can you walk me through a real example of how this played out for an investor you worked with?
I'll tell you about a client, I won't use their name, and they came to me after being turned on by two other lenders. He's a business owner, very successful, but his tax returns show low personal income because he runs everything through the business. On paper, a traditional lender looks at his tax return and says, "You don't make enough to qualify," which is almost comical given what his business actually generates. But that's how traditional underwriting works. In his case, we went DSCR route. The property wanted to buy a 4-unit in a strong rental market, had projected rents of $5,800 a month. His total PITI payment would have been $4,200 a month with a DSCR of 1.38. He closed in 32 days. He's since bought 2 more properties the same way. See, his personal income never came into it because the properties qualify on their own.
What do most investors miss about DSCR financing, the thing that's not obvious until you've done a few of these?
A few things. 1, market rent matters as much as a purchase price. A property in a strong rental market with high demand can have a great DSCR, even at a higher price point. A property in a soft rental market at a low price may not qualify. You got to run the rental math first. Number 2, DSCR loans allow unlimited properties in most cases. Traditional Fannie Mae financing caps you at 10 financed properties. DSCR has no such limit. So serious portfolio investors use this to scale. 3, these are not a substitute for running real numbers. I see investors get excited about DSCR and stop doing the actual investing analysis. The loan qualifying and the investment penciling are 2 different things. You need both.
What's the most common mistake you see investors make when they're getting into rental property financing?
Really, it's waiting until they find the property to figure out the financing. They see a deal, they get excited, they call me with 10 days before closing, and we can usually make it work, but not always. Investors who move consistently have their structure figured out before they're shopping. They know their DSCR target, they know their down payment, they know exactly what kind of property they're looking for. The investors I watch build real estate portfolios are the ones who treat financing like a tool they understand, not a hurdle they have to figure out after they've already committed.
If someone watching is seriously thinking about buying their first or next investment property, what do they do right now?
First, run the rental income math on the property or market you're targeting before you do anything else. What does comparable rent look like? Does the income cover the expected payment? Second, know your down payment. DSCR typically requires 20 to 25%. Have that number clear before you start looking. And third, call me or a lender who understands DSCR before you make an offer. A 15-minute conversation will tell you what you qualify for and what kind of deal will work.
And if they want to explore whether DSCR financing makes sense for their situation specifically.
Take the 3-minute home loan quiz on my website. There's a path for investors. I'll send you a personal response or reach out directly and we'll run the numbers together on whatever deal you're looking for. Investor financing is one of my specialties, and this is exactly the kind of conversation I'm here for.